Welcome to CRE Fast 5. I'm Iacono, and tonight we are discussing inflation. This week there have been many conflicting viewpoints on the reported CPI number of 4.2%, which is in fact the largest jump since 2008. Some economists are saying stay calm, this is simply transitory inflation, while others are ringing the alarm bells. Tonight I want to give you a few data points on the topic of inflation and tie it back to consumer demand. Here we go. As I alluded to, the Consumer Price Index, which measures a basket of goods as well as energy and housing costs, rose 4.2% from a year earlier. Keep in mind that this is a year-over-year comparison, however, and inflation was extremely low this time last year due to the pandemic closures. The impact of a distorted comparison year is called base effects, and we may see skewed year-over-year data for the next few months in general. A recent CNBC article noted that federal officials repeatedly have said they will not raise interest rates or pull back on monthly bond purchases until inflation averages around 2% over an extended period. So the data coming out in the next few months and really through the end of the year will be crucial in driving monetary policy. If inflation averages down to a sub 2% range and last month is seen as an anomaly, you could interpret this to mean the growth is healthy and not economically detrimental. If we see back-to-back months at over 4%, that may tell a very different story. So what do economists believe is driving the significant jump in inflation that we saw last month? Number one, wages. Last week's job report pointed out labor shortages in low-wage industries, which is leading to employers raising wages. Number two, stimulus. Government stimulus could be overdone. Some economists worry massive government stimulus payments are contributing to the problem and say the Fed is really being too placid. So this discussion is often tied back to point one, the labor shortage issue. Some believe labor shortages are tied to the high stimulus payments as certain employees choose to remain out of the workforce. Number three, skewed data from a few categories could be shaping the numbers. A handful of categories are driving the jump of inflation, and the real number could be viewed as much lower. CoStar published a great article on Wednesday citing that nearly 1/3 of the 3-point rise in core CPI over the past year is attributable to the prices for used cars alone. The three sectors that are making the biggest impact on the inflation trend are used autos, public transportation, and lodging away from home. However, these sectors make up a mere 6.5% weighting in core CPI, but they've seen such severe swings since this time in 2020 that they're really having an outsized impact on the overall numbers. That said, real price inflation is still happening, which brings me to the fourth driver, cost of goods sold. Half of April's monthly inflation number was due to the rising price of durable goods. Consumers have a lot of dry powder, and demand for many goods such as building supplies, electronics, appliances, and food service has shot up. In many sectors, the increased demand is being coupled with supply chain bottlenecks, which is driving prices up further. A survey from the Institute for Supply Management, or ISM, published on Monday, showed record-long manufacturing lead times, wide-scale shortages of critical basic materials, rising commodity prices, and difficulties in transporting products. So the supply chain bottleneck is a very real problem. All 18 manufacturing industries continue to face expanded demand at the same time they're dealing with these supply shortages and bottlenecks. In April, for example, furniture manufacturers reported that market capacity in most areas was completely oversold and demand was likely to continue to strengthen, which could lead to more significant disruptions. In the plastics and rubber product sector, lead times were the longest in 35 years for some factories. Lumber prices, which we've all heard about, have increased more than 250% in the last year alone, according to Business Insider. Manufacturers are also complaining about steel prices, with makers of fabricated metals describing them as crazy high. So now the question really is, are we experiencing transitory inflation due to unprecedented circumstances that will level out in the coming months? Or is the confluence of factors such as supply chain issues and consumer demand putting us in a dangerous position of rampant inflation longer term? With 23.6% of all US dollars having been printed in the last year, there are certainly many ways the next 12 months could play out. That was CRE Fast 5. I'm Carly Iacono. I look forward to seeing you again next week.